Introduction. Welcome back to part 2 of our series on the psychology of money. In this video, we will be diving deeper into the insights and concepts covered in the book, with a focus on chapters 8 through 14. Chapter 9 of The Psychology of Money by Morgan Housel is titled Man in the Car Paradox. In this chapter, Housel explores the concept of financial freedom and how it relates to our behavior and decisions around money. The man in the car paradox refers to a scenario where someone who is financially independent and has more than enough money to sustain their lifestyle continues to work and accumulate wealth. Housel explains that this paradox exists because the freedom that comes with financial independence is often different from what we expect. For example, someone who has spent their entire life working and saving for retirement may find that they don't know what to do with themselves once they actually retire. They may have defined their sense of purpose and identity by their job and the routine it provided. In contrast, someone who has found a fulfilling and enjoyable career may not feel the need to retire at all, even if they have the financial means to do so. Housel also points out that money is a tool for achieving what we want in life, but it's not the only tool. Money can buy material possessions and experiences, but it can't buy love, meaning, or purpose. Therefore, it's important to be intentional about how we use our money and to prioritize the things that truly matter to us. Housel gives examples of people who have used their financial independence to pursue passions and hobbies, start philanthropic organizations, or even just spend more time with loved ones. He also emphasizes the importance of being flexible and adaptable in our financial plans, as unexpected events can arise that change our priorities and goals. Overall, the man in the car paradox serves as a reminder that financial freedom is not an end in itself, but rather a means to achieving a fulfilling and meaningful life. It's important to align our financial decisions with our values and goals, and to recognize that money is just one tool in the toolbox of life. Chapter 10 of The Psychology of Money by Morgan Housel is titled When You'll Believe Anything. In this chapter, Housel explores the ways in which we are influenced by our beliefs, biases, and emotions when it comes to investing and financial decisions. Housel notes that humans have a tendency to believe what we want to believe, even in the face of contradictory evidence. We also have a bias towards stories and narratives, which can sometimes lead us to make irrational investment decisions based on anecdotes and emotions rather than data and analysis. One example that Housel gives is the case of the Nifty 50 stocks in the 1970s. These were a group of 50 blue-chip stocks that were seen as one-decision investments that would only go up in value over time. Many investors bought into the hype and paid high prices for these stocks, but when the market turned in the early 1970s, the Nifty 50 stocks suffered large losses. The lesson here is that it's important to be skeptical of popular narratives and to base investment decisions on sound analysis rather than hype and emotion. Housel also discusses the concept of overconfidence, which is when we have too much faith in our own abilities and the accuracy of our predictions. Overconfidence can lead us to take on too much risk in our investments, as we believe we have a better understanding of the market than we actually do. To counteract these biases and emotional tendencies, Housel recommends a number of strategies, such as developing a long-term investment strategy based on sound analysis and data, diversifying investments across different asset classes and geographies, and seeking out information from a variety of sources to challenge our own biases and beliefs. Overall, Chapter 10 of The Psychology of Money reminds us that our beliefs and emotions can have a powerful impact on our financial decisions. It's important to be aware of these biases and to take steps to counteract them, in order to make rational and informed decisions that align with our long-term financial goals. Chapter 11 of The Psychology of Money by Morgan Housel is titled Nothing's Free. In this chapter, Housel explores the hidden costs and trade-offs that are involved in many financial decisions, and the importance of understanding these costs in order to make informed choices. Housel gives the example of credit cards, which offer the convenience of easy and instant purchasing, but often come with high interest rates and fees. He notes that the true cost of a credit card purchase may be much higher than the sticker price, and that it's important to be aware of these costs when making purchasing decisions. Another example Housel gives is the trade-off between risk and reward in investing. Higher risk investments may offer the potential for higher returns, but also come with the potential for larger losses. It's important to understand and accept the risks involved in any investment, and to make sure that the potential rewards are worth the potential costs. Housel also notes that many financial decisions involve trade-offs between the present and the future. For example, Saving for retirement may require giving up current spending and lifestyle choices, but can provide financial security and freedom in the future. Similarly, investing in education or career development may involve short-term sacrifices, but can lead to long-term gains. The key takeaway from Chapter 11 is that nothing is truly free in the world of finance, and that it's important to be aware of the costs and trade-offs involved in any financial decision. By understanding the true cost of a decision, we can make informed choices that align with our long-term financial goals and priorities. Chapter 12 of The Psychology of Money by Morgan Housel is titled The Seduction of Pessimism. In this chapter, Housel explores the ways in which pessimism and negative thinking can influence our financial decisions, and the importance of maintaining a balanced perspective. Housel notes that humans have a natural tendency to focus on negative news and to assume that bad things are more likely to happen than good things. This can lead to a sense of pessimism and a belief that the future is likely to be worse than the past or present. One example that Housel gives is the stock market. Despite its long-term history of growth and positive returns, many investors are fearful of investing in the stock market because of the possibility of short-term losses or market downturns. This pessimistic mindset can lead investors to make suboptimal decisions, such as staying out of the market altogether or selling at the bottom of a downturn. Housel also notes that pessimism can be seductive because it allows us to feel like we are being cautious and responsible with our money. However, this mindset can also lead to missed opportunities and can prevent us from taking necessary risks in order to achieve long-term financial goals. To counteract pessimism, Housel recommends focusing on the long term and taking a balanced perspective. This means recognizing that both good and bad things can happen in the future, and that the world is generally becoming more prosperous and less risky over time. It also means avoiding extreme thinking and being open to changing our minds in the face of new evidence or information. Overall, Chapter 12 of The Psychology of Money reminds us that pessimism and negative thinking can have a powerful influence on our financial decisions. By maintaining a balanced perspective and focusing on the long term, we can make more informed and rational decisions that align with our long-term financial goals. Chapter 13 of The Psychology of Money by Morgan Housel is titled The Second-Order Consequences of Your Decisions. In this chapter, Housel explores the concept of second-order thinking and how it can help us make better financial decisions. Housel defines second-order thinking as the practice of considering not only the immediate consequences of a decision, but also the longer-term and indirect consequences that may result. He notes that many of the most important financial decisions we make have second-order consequences that are not immediately apparent. One example that Housel gives is the decision to buy a home. On the surface, buying a home may seem like a good financial decision because it allows you to build equity and potentially earn a return on your investment. However, there are also many second-order consequences to consider, such as the cost of maintenance and repairs, property taxes, and the impact on your mobility and career opportunities. Another example that Housel gives is the decision to take on debt. While debt can allow you to make purchases or investments that you otherwise couldn't afford, it also has second-order consequences such as interest payments, fees, and the impact on your credit score and financial flexibility. Housel notes that second-order thinking can be difficult because it requires us to think beyond the immediate benefits of a decision and consider the potential costs and trade-offs over time. However, he also notes that taking the time to consider second-order consequences can help us make more informed and thoughtful decisions that align with our long-term financial goals. The key takeaway from Chapter 13 is that many financial decisions have second-order consequences that are not immediately apparent. By taking the time to consider these consequences and think beyond the immediate benefits of a decision, we can make more informed and thoughtful choices that align with our long-term financial goals. Chapter 14 of The Psychology of Money by Morgan Housel is titled You'll Change. In this chapter, Housel explores the ways in which our financial goals and priorities can change over time, and how we can adapt to these changes. Housel notes that our financial goals and priorities are often influenced by our life experiences, such as our career path, family situation, and personal values. As we grow and change, our financial goals and priorities may also change. One example that Housel gives is the idea of financial independence. For many people, financial independence means being able to retire early or quit a job that they don't enjoy. However, as people reach financial independence, they often find that their goals and priorities shift. They may decide to pursue new career opportunities or start a new business, rather than simply retiring. Another example that Housel gives is the role of money in our personal relationships. Our financial priorities can change as we start a family, get married, or go through a divorce. These changes can have a significant impact on our financial decisions and goals. Housel notes that the key to adapting to these changes is to stay flexible and open to new opportunities. This means being willing to adjust our financial goals and priorities as our life circumstances change, and being open to new ways of thinking about money and investing. Overall, Chapter 14 of The Psychology of Money reminds us that our financial goals and priorities are not set in stone. As we grow and change, our financial needs and aspirations may also change. By staying flexible and open to new opportunities, we can adapt to these changes and continue to make informed and thoughtful financial decisions that align with our long-term goals.